So moving expenses, that has been done away with. So let's say you're working for an employer and they say, hey, your next paycheck is in Tulsa, Oklahoma. Move up there, and I'm not going to pay you to move. You have to pay for it yourself. Well, it used to be you could deduct those expenses. You can't anymore. So if your employer wants you to move to Tulsa, you don't want to move, you have to quit your job and find something else. Why would anybody move to Tulsa? Terrible example. Anyway.
Only because your employer told you to.
Yeah, only that. So, but this is still allowed for members of the armed forces on active duty, and the move is pursuant to an order. But that's the only case that this is allowed now. This expires after 2025. So, if your employer wants you to move to Tulsa, tell them to hang on, wait until 2025. Gambling losses. In prior years, let's say you go to Lake Charles and you have a nice weekend, you gamble a lot, and you win a little, you lose a little. You make several trips during the year. Some trips you win, some trips you lose. Well, your losses you can deduct from your winnings, and no more. That's all you can deduct, up to your winnings. And previously, under the prior law, if you were a professional gambler, this is how you made your living, then you could actually consider it a business and file it on a business return and take business deductions, including mileage to and from Lake Charles or Las Vegas or Atlantic City, wherever you do your gambling. But the law, the way it was written before, was very sketchy, and the IRS was coming down on people, making them prove that you're a professional gambler and so on. Well, now the new law gives provisions that allow for professional gamblers to claim their traveling expenses and so on. So let's say you're a professional gambler. You go to Lake Charles. You stay in a nice hotel. You have meals, your travel expenses. All that would be deductible from your winnings. It's pretty nice. But if you're a casual gambler, like most of us, your losses you can deduct from the winnings you make. So my advice is, if you're a casual gambler, keep record of what you've lost, because sometimes you'll win. And when you win, believe me, the casino will send the IRS what is it, a 1099-G or whatever, I'm not sure what it is. But there's some 1099 form that they send the government that says that you won so much money. So the government will know. The government will know what you won, but the government will not necessarily know what you lost. So keep records. Okay. I had a client a few years ago that won the lottery here in Texas, one of the scratch-offs, and I think it was one of those that was around 25,000, something like that. But of course, in order to get that, he bought tons and tons and tons of those scratch-off tickets. Well, he saved all those scratch-off. He brought in 2 boxes full of these scratch-off tickets that he had accumulated during the year. Well, the cost of those scratch-off tickets were deducted from his $25,000 of winnings, making his taxable winnings a little bit less. So it helps. But you have to keep records. You don't have records, you pay on the whole thing.
Which just shows you how much you don't make, because all the money you spend.
So yeah.
You don't win because you already lost so much.
Now let me go through the Schedule A, because this is what you were talking about with mortgage deductions. On Schedule A, this is what we call the itemized deductions. So you remember when I had the simplified flow chart there for the tax calculation? I said that you could either take a standard deduction or an itemized deduction. You itemize when you think that your total of all these expenses exceeds whatever your standard deduction is. So now this year, since our standard deduction for married filing jointly has gone up to $24,000, that means that all this stuff has to add up above $24,000 for it to make sense to do itemized deductions. Otherwise, you do standard. Let me give you my example. My example, I've been in the same house for almost 30 years. My mortgage is almost paid off. The interest is very tiny. I give a lot of money to the church. I have a lot of money in property tax and all of this other stuff. So last year in 2017, added it all up, I think my total itemized was around 14, just a little over 14,000. The standard was 12,600 I think it was. So, so it made sense for me to itemize. Well, this year, my mortgage interest is even less. My property taxes are a little bit more, but not much more. And my giving is less because I'm not, I'm retired from my engineering job. So this year, man, that standard deduction of 24,000 benefits me like crazy. So, but these are the items that were part of the itemized deduction Schedule A. Medical and dental expenses, and these are groups. These are all grouped. Medical and dental expenses, taxes you paid, which means property tax, state income tax, perhaps foreign property tax. Did I say sales tax? Either sales tax or state income tax. Yeah, you can't do both. So in Texas, we only have sales tax. In California, you could do sales tax or state income tax, either way. Then interest you paid, and that is primarily just your mortgage interest. Gifts to charity, casualty and theft losses, job expenses and miscellaneous deductions subject to 2% of AGI, and other miscellaneous deductions. Now I'm going to go through these in detail and show you what some of the changes have been. So, for medical and dental expenses, previously, there was an AGI threshold. Your AGI, your medical and dental expenses had to exceed 10% of your adjusted gross income. If it did not exceed 10%, then you couldn't claim any medical expenses. So, for most people who have medical insurance, you have no deduction, because this is out-of-pocket expense. Okay.
Not including your premium, right?
And good point. Your premium, if you're working for an employer and you have employer paid, you're paying a premium through your employer, that premium is coming out of your check before taxes. So no, you can't deduct that. But if you've got Obamacare, if you're purchasing insurance on the marketplace, that's coming out after taxes. That, yes, you can claim.
Oh.
Okay?
So self-employed would be the same, right?
Self-employed is the same thing. Yeah. Well, self-employed is better, because with self-employed you can deduct. You don't have to meet a threshold.
Oh.
So, yeah, for self-employed health insurance, it's an adjustment to income. Yeah.
So how would that work then? Say you have well, like our case, right? So I'm self-employed, Rhea's W-2. Obviously we have a family plan. So, I mean, we don't have to meet the threshold simply because I'm self-employed, even though she's W-2?
I believe it is just for your portion, your insurance.
Oh, fine.
Yeah, for the employee. I don't think it covers family. So self-employed is for the person, for the adjustment.
How would you calculate? Because I mean, if you have a family plan, you pay one premium.
Right.
The single price.
I'd have to check on that, Billy, to be honest with you, because I know that there's a caveat there. Generally speaking, like for example, in my case, with my income tax business, the premium that I pay, it's only for me, and the premium I pay, I can deduct as even though it's Medicare, I can deduct my Medicare premium as self-employed health insurance because I'm self-employed. And it doesn't cover it doesn't cover any other family members. So in your case, I will look it up and I'll get back to you. So that's a good question, I really don't know. If I don't have clients that have that situation, it never comes up. So I'll find out. So effective last year, that threshold was lowered to 7.5%. And it's staying at 7.5% through this year. Beginning, so when you file your taxes this year, the threshold's still 7.5%. Next year, when you file your 2019 taxes, the threshold goes back up to 10%. I don't know why they did this. They did this lowering of the threshold for 2 years. Didn't make much sense to me, but you know, if you're lucky, maybe it'll help you. I don't know.
That's to entice you to vote Republican.
Yeah, there you go. Vote Republican. There you go. You know, it's funny when you really study what they had to go through in order to get all the provisions of this bill. A lot of these things that are set to expire, they really didn't want to expire. But they had to do it that way in order to pass the Congressional Budget Office measuring threshold or something.
Yeah.
Yeah, so I'm sure it's very complicated, and I have no idea what to do. Anyway, now on your taxes, this has been a big change. You can claim, this has always been the case, either state or local income tax, I'm sorry, either state and local income tax or general sales tax, but not both. Real estate tax and personal property tax. Now, one mistake that I see on a lot of tax returns is people seem to think that your vehicle registration that you pay is personal property tax. In the state of Texas, that ain't so. Why? Because, as I keep telling you, the state of Texas is God's country. We don't do that. We don't charge personal property tax on your vehicle. In California, that evil state on the West Coast, they do. So in California, when you register your vehicle, they break out the personal property tax and the vehicle registration. The portion that's personal property tax, you can deduct. The vehicle registration, you cannot. So be forewarned. I see a ton of people that do that, and it's.
So, if you want to claim general sales tax, do you have to keep your records and like?
Yeah, good
you
question.
buy something like maybe $5.
Good question. There's 2 ways you can do it. You can save all your receipts, add them all up. Sometimes maybe that'll be worthwhile. Generally, no. There's a table that if you use tax software like TurboTax or any of those, they do it automatically. But if you do it by hand, you can look up. There's a sales tax table that you can go to, and depending on your adjusted gross income, it'll tell you how much money you can claim off of that table as deductible sales tax. And on top of that, if you have a major purchase, if you purchase a vehicle, a car, motorcycle, boat, or airplane, the sales tax on that can be added to that amount on the table. But those are the only things that can be added. Follow what I'm saying? Okay. Did you have a question?
No, I just want to mention about that. If you make a car purchase or a vehicle purchase or something, or a boat purchase, the sales tax you pay when you buy it the first year, you can add it to your general sales tax.
Also, the general sales tax plus that.
Plus that.
Right.
Oh, wow.
And the other thing, okay, let me, how many of you use tax software? TurboTax, TaxAct, whatever? Okay, let me give you a heads up. When you do your taxes, and you get to that point about the sales tax, and you tell it that you're in the state of Texas, there's also, state of Texas only charges 6.25%. Local, you're in Harris County and Fort Bend County, they charge 2%. So it's 2% added on to that 6.8. So when you buy anything here in Fort Bend or Harris County, you're paying 8.25%. So on your tax software, you want to make sure you add, they have a little slot on there for local sales tax. And if you don't put anything in there, it's going to be 0. You have to manually put it in there, because they don't know what county you live in. If you don't put in that 2, it's only going to give you 6.25%. So how about that? I just saved you money.
So on that point, Jim, 2 questions. Number 1, what are your thoughts on keeping receipts original versus scanned? And secondly, do you mind endorsing or recommending some budgeting software that you personally have found to be useful?
Budgeting, you mean,
Like, the ones that may be available out there, like, Mint, Quick something,
QuickBooks.
Or, yes.
I've heard a lot of good things about QuickBooks. I've not used it myself. I just use an Excel spreadsheet for budgeting.
Like keeping track of your expenses more so.
Yeah, I've heard a lot of good things about QuickBooks. And if I were to go that route, if my business suddenly became a lot more complicated, I'd probably do that. I don't know about any of the others. I'm sure, you know, they're all pretty good. As far as keeping original receipts versus scanned copies, the IRS used to have a problem with that. But the way I understand it now, they've kind of come into the 21st century, and they're saying that they realize that a lot of the original receipts, if you keep them for, especially for a number of years, they fade out and become unreadable. You know, so yeah, my understanding is keeping scanned receipts, electronic copies is acceptable.
But if you're using a table, you don't need it anymore, right?
If you're using the table, yeah, you don't need the receipts. Yeah, but like for other things, like for business expenses and so on, you do need receipts, and I'll get into that in a little bit too, but because that gets really really touchy. You know, I'm sorry, I just noticed that the time is 8:30. If you want me to continue, I can continue.
Yeah.
Okay. I'll go a little bit faster. I'll skip over some of the stuff. The new law limits the state and local tax deduction to $10,000 for income, sales, and property taxes. States like New York, Illinois, California are squealing like pigs. Why? Because they got extremely high state income taxes. And for somebody who makes an engineer's salary, they're paying easily more than $10,000 combined income, state income and property taxes. So now they're being limited. In Texas, we don't have as much of a problem, but like you mentioned, we get screwed on property tax. And so like if you live in a fairly nice neighborhood, in a fairly new home, you might be getting close to that $10,000. Right? I mean, it's very, now like in my old rundown place, I've been living in for 30 years, you know, I'm not quite there yet. I'll probably get there in a couple of years, the rate they're going.
200,000 times 4% is 13.
And these new provisions expire after 2020. Mortgage interest. It's reported on Form 1098, it's deductible. Also, points not reported on Form 1098 are also deductible. But beginning in 2018, mortgage interest is limited to the first $750,000 in principal value. It used to be $1 million. It lowered it. Okay? So if you're going out and buying a new house, like I have a client in Virginia that just built a new house, and his is well over that $750,000. The amount of interest on the $750,000 is all he can claim. The rest of the interest is on him. Okay.
So, define principal value. Is it market or how much you're owed?
No, principal is what you borrowed.
Okay.
What is owed, what is still owed, the balance. So like if you buy a new house, $500,000, and borrow that $500,000, that's the principal. But now as time goes on, like on my house, my principal now is around $50,000, because that's, everything's been paid down. But it's talking about the original principal, so that means when you took out the loan.
Oh, the original price.
Right. So if your original principal was, now this is grandfathered, so obviously, if you bought your house in 2017 for over $1 million, or for around $1 million, you're okay. You're okay. But if you're buying the house now, in 2019, or actually in 2018, from 2018 on, you're only protected at that $750,000 threshold. Does that make sense? Okay. And home equity indebtedness is no longer deductible. They just, so like, you used to be able to take out a home equity loan to, pay off credit cards or whatever. No. But you can, if it adds to the value of your home, then you can deduct it.
So
See-
home improvement is still allowed.
Yes. See, unless it is used to buy, build, or substantially improve the taxpayer's home, which secures the loan. So it would be like a second mortgage. Although we don't call them second mortgages here in Texas. It's still the same thing. All right, gifts to charity. A written receipt is required for any contribution of $250 or more. Now that's any single contribution of $250 or more. So if you gave $50 to United Way, you don't need to keep that receipt. But if you gave $300 to United Way, you need to have a receipt. Now, I've always had people ask me, well, what if I don't keep a receipt? Well, according to all the taxpayers that get audited, the whole population, about 1% get audited. About 1%. But there are certain things in your tax return that may trigger a higher percentage. If you're one of the lucky ones that win the IRS lottery, they're gonna ask you, they're gonna go through line item by line item, and they're gonna ask you, do you have receipts for this? May I see them? I don't have it, okay, disallow it. And now you have to pay tax on that, plus penalties and interest.
So
So-
this is get a receipt ready, but we don't submit it with the return.
No, you keep it. Yeah, you keep it with your records.
For how long?
Well, generally they say up to 3 years. I think that's bad advice. I would say up to 7 years.
7.
A lot depends on, if you're just a wage earner and you're not doing heavy duty investing and taking, risks with deductions, if you don't own your own business, if none of that applies to you, I'd say 3 years is probably good advice. But if you're taking chances on anything, 7 years. And why do I say 7 years? Because they can go back 7 years or more if they suspect that you willfully or negligently reported something without the receipts. There's a willful and negligent clause in there. They can go back 7 years. If they find it to be criminally negligent, they can go back as far as they want. Maybe that's why Trump doesn't want to show his tax returns. Anyway. Non-cash contributions, like your clothing and furniture that you give away to Goodwill, any contributions over $500 in total require Form 8283. It's just another form. So if you're using tax software, TurboTax, Tax Act, any of those, they should trigger that. They should ask you, did you make clothing donations or non-cash contributions in excess of $500? And if you answer yes, then they're going to ask you a lot of questions. Who did you give it to? What's their address? What was the fair market value? So you need to be prepared for that. People do get audited on this because people overstate. Guess who one person who was audited on this? Guess who? You'll never guess. In a million years. Nancy Reagan.
Oh, really?
Yeah, when Ron and Nancy were president and first lady, she, after they left the White House, she claimed a very, very large deduction for some of these very, very expensive evening gowns that she only wore once. She got audited. Isn't that interesting?
So I thought hire a CPA or something.
Well, just because you have a CPA that's no audit protection. Then the CPA has to come in and talk on your behalf. So it's a good idea to, especially if you're clearing out the house of all, your kids grow up and move away, you're clearing out their bedroom furniture, you're clearing out all the toys, all this stuff, it's still usable, it's still got value. Take little pictures of it and just say, you don't have to give everything a value, but you can say, I have 10 men's shirts or 5 boys' trousers. And then you can look up online the thrift store value of those items. Salvation Army, for example.
If I give to someone, a refugee,
Well, if you give it to someone who is not a 501c3, you don't get a tax deduction. Tax deductions only go to tax exempt organizations. That's all. So if you give it to a guy on the street, God bless you, but no tax deduction.
Excuse me.
Yeah.
I have CPA, so every year I always collect all the receipt, and then before I send to my CPA, I always put like for gas or grocery in the big Ziploc, and then I thought this can save the money, but some people they just like print out from the bank statement. This is the best to collect the receipt or just to print out the bank? Because
Depends on what the
receipt
receipts
is
are used
lot
for.
too.
Yeah, it depends on what the receipts are used for. If they're used for a business purpose, you should either keep them or keep a scanned copy. If you paid for it with, and the reason it's good to keep the receipt is because it shows who was paid. Now, if you keep a canceled check, that shows who was paid, but the canceled check doesn't necessarily tell you what it was that was purchased. The receipt tells you everything. You know. So now, like for groceries aren't deductible unless it's for a business purpose. Sales tax, if you're saving all the receipts, so you deduct sales tax that way.
Yeah, in the grocery they have the sales tax.
Yeah, that might be, but you know, unless it adds up to an awful lot, you're probably wasting your time. You could do that.
My CPA said that you have to collect all the receipts.
If you use receipts, that's, you have to have it. Yeah. Yeah. Anyway, let's see. Oh yeah, and for property with a value over $5,000, you need to get an actual appraisal from a licensed appraiser. This would be like things like, I had a client that donated a Cadillac to a ministry. It was some kind of homeless ministry or something, I can't remember exactly what. But the Cadillac was a used Cadillac, but it still had a value like $12,000. So he went and got it appraised, and we claimed that as a charitable donation. We have the appraisal, everything was done right. You can't just say, oh yeah, well, blue book value is this. No, that's not gonna work. You have to have it appraised. The same thing for jewelry. If you have jewelry, you donate the jewelry, get it appraised. Because the date of the appraisal also matters.
But that's the same thing though, you just have it ready, the appraisal certificate, whatever, but when you just have to pay in whatever the appraisal value and your return, right? You don't have to attach anything.
No, you don't have to attach anything.
But if you, I guess some charities do the appraisal for you, so you just give it to them and they'll give you the statement along with the
Yes.
appraisal.
Yes. Yeah, especially these charities accept vehicles.
Yeah.
Yeah, they do that. They do.
So here's my question.
Yeah.
Oftentimes, we have been holding quite a lot of venues which are designed to attract charitable contributions from whoever comes for earthquake or flood victims, for example. And how are you, what's a couple of tips to, from you to make sure that the contributions given at that event will entitle the contributor to get tax deduction based on
Well,
charity?
okay, if your organization is a 501c3,
Let's say it's not. Let's say it's a group of volunteers. Let's say us, that we want to just have a gathering and then everybody chips in to I don't know, to a charity back in Indonesia, for example.
okay. Well, okay, for a foreign charity, unless they're registered in the United States as a 501c3, no donations to a foreign entity are deductible. So that, now, I know that there are some missions overseas that may be specifically in Indonesia and they may be registered with a US ministry, well, in that case, it would be deductible. Okay. But let's say that a bunch of people are getting together for, let's say Hurricane Harvey relief, and you were collecting donations for Hurricane Harvey relief. It would not be deductible for the contributor if they're giving you the money and then you distribute it. If they wrote the check, say to Red Cross, then it would be deductible. If they wrote the check to Red Cross and gave it to you and then you took it to Red Cross on their behalf, everything's fine. But if they wrote the check to you or your organization and your organization is not a 501c3 tax exempt corporation, then they don't get a tax break. Yeah, I've been dealing with that with ministries as well for overseas donations, and that's part of the problem. Yeah. So if it's a small ministry overseas, generally they may not even be aware that to get tax-free contributions from the U.S., they have to be registered. So I mean, in that case, you know, if I'm soliciting donations, I would solicit it on the behalf of the humanitarian cause rather than any tax-free donation aspect.
Okay.
Yeah, does that make sense?
So for example, we collect the money from the people here, from Indonesia as well, and then we give to the Red Cross here to give to the Red Cross in Indonesia. The people who donate will get a tax deduction.
Yes,
Okay.
yes, that's perfectly legit.
So we just give the money to Red Cross, and then we ask the Red Cross here to deliver to the Red Cross in Indonesia.
Right.
Or IDF, Indonesian Diaspora Foundation, is also 501c3.
Virus.
Yes.
Yeah. That's what we
Yes.
did actually. We gave to IDF, but the problem is we don't take a note who gave the money.
Yeah, so when you take a note who gave the money and report it to IDF would issue
give to issue the
to each person.
then it will be tax.
So they will
deduction.
give the statement at the end of the year.
Right, that's right.
But that's only if it's more than 250. If it's less,
If
then you
it's,
don't need
yeah,
a
If it's more than
if it's more
200
than 250, that's when you need the receipt. If it's less than that, you don't even need a receipt.
Okay.
You just-
If each individual gave less than 250, then they can just say I gave 249 to IDF, and that's fine. They don't need a receipt from IDF.
That's right.
Yeah, but if you give 255, for example,